Thank you all for joining us. We're here today to talk about topics and themes in the interest rate environment. As we've seen, the Fed's raised rates by 525 basis points since March of 2022. It seems we may be at the peak or close to the peak of this rate hike cycle, which leads us to a potential pivotal point. I'm Nanci Fastre, Managing Director on our Liquidity Advisory team. With me today are Jose Sevilla and Jeff Probst, Portfolio Managers from our Asset Management team. Together, Jose and Jeff have more than 40 years of combined experience in fixed income and working with our corporate cash clients. We can go ahead and forward a slide. We have some housekeeping items today. All lines have been placed on mute to prevent background noise. The chat function has been disabled, but please feel free to submit any questions through the Q&A function. And after the webinar, we'll go ahead and send a link to the recording. Hey, Jose, with the rise in rates over the past 18 months, where are we today?
Thanks, Nancy, and thanks everyone for joining today. Yeah, so I mean, that's really the question is what's going on in the markets today and what's come top of mind. And really, as you know, economic activity in the labor markets have been strong. The economy has been resilient. Looks like growth is well above trend, and the Fed has upgraded their forecasts for this year and for next year. And with regards to the unemployment picture, I mean, the labor markets remain tight. Unemployment rate continues to be historically low, currently at 3.8%. And really what we've been really considering also is really what's contributing to a lot of the uncertainty in the markets is this divergent views between what the Fed is thinking and what the markets are thinking with regards to where rates are going to be headed. And please jump onto the next slide really quickly. And really, everyone is really focused on what will the Fed do next. And at this stage, the Fed has hiked rates, as Nancy had mentioned, more than 5% since March, the fastest it's been since 1980. And really, the question is, what will the impact be on, what will the impact be on the economy? And will these rate hikes be enough to quell the high inflationary environment? And I don't think we've seen the full effects yet of these rate hikes to fully played out, and the toll of these high interest rates will continue to build in terms of how it will affect the economy. And it is debatable whether or not the Fed is at or near the end of the tightening cycle. However, the markets are less focused about where the hikes are headed, or how much hikes are left, and really geared or at least focused on when that first rate cut will occur, which again, it's really hard to time. So we really have to consider looking at past hiking cycles, past cycles to really determine what the effects will be. And as you can see on this slide here, really just focusing on the speed at which rates have dropped after they've reached their peaks. I mean, take for example, during the greater financial crisis when it was creeping off of zero, where it took about 4 years, right, for the Fed to hike 225 basis points, and then to turn around right around the time when COVID hit, right, where it took about 228 days at which they cut rates by about 2.25%. Another time was the housing market, or the cooling of the housing market at that time when the Fed raised, from 2004 to 2006, 425 basis points, and then to turn around when the housing bubble burst and quickly cut rates by 5.25% over the course of 455 days. And again, just to reiterate the speed at which the Fed had cut rates during those time periods. And can we move to the next slide? So which gets us really now to the question that probably everyone is asking: are we nearing the end of the tightening cycle? And what you can see here is the current tightening cycle that started back in March of 2022. And we really want to talk about here is the 3 phases that have happened here, right? And really what we want to take away from this is markets are always trying to anticipate what the Fed is going to do, the move is going to do. And you can see here in the first phase, which is what I call the pre-tightening phase, the U.S. economy was coming out of COVID, so it was improving when it was coming out of the pandemic. And during that time period as well, the Fed maintained that inflation was transitory, right? And in fact, to provide some metrics during that time period, I think core CPI, or excuse me, core PCE, which was the Fed's preferred inflation gauge, was right around 5%. Headline CPI was around 7% during that time period. And as you can see here, the 2-year note, right, was anticipating the Fed moving, because at that time, markets were, or excuse me, the Fed was forecasting that it was going to raise rates one time in 2022 and only twice in 2023, which gets us now, as we get into what we call the aggressive phase. There was aggressive tightening by the Fed to ward off stubbornly high inflation. And then at that period of time, that was when the Fed finally concluded that inflation was no longer transitory. They raised the Fed funds rate 7 times. And in fact, inflation hit a high during this time period of 9.2% year over year. And that was around June of last year. And you can see here, again, with the markets anticipating what the Fed was going to do, the 2-year note continued to yield well above what the Fed funds rate is showing here, because the Fed funds rate was basically playing catch up, right? And then as we get into what we would call the concluding, or maybe the peaking phase, which, you know, at this point, is it peaking? And it's really uncertain, at least at this point. However, there is some signs to that with regards to whether or not maybe we are hitting the peak, or we're closer to the end, so to speak. As some of the signals were, the Fed paused hiking rates in June of this year and September of this year. You can see here that the 2-year note was pretty well anchored at around 5%, right? And the question is now, has the 2-year note has interest rates made us run using the 2-year note as a proxy? And as you can see here, there's a reversal now in which the Fed funds rate is higher relative to the yield on the 2-year US Treasury, which is basically telling us that cuts are coming. So which gets us really now to what the outlook is for rates, and really speaking to the divergent views. If you can move on to the next slide. And I'll just lean on this really quickly here. And you can see, as mentioned earlier here, that there are some divergent views in terms of what the Fed is expecting versus what the markets are expecting. With regards to the Fed, initially, you can see here that the narrative for the Fed is this higher for longer. However, they expect inflation will eventually drop down to their preferred 2% target. However, over the longer term, you can see that there's going to be some aggressive cuts being priced over the longer term, eventually getting to that long-term projection of 2.5%. Meanwhile, the markets, on the other hand, are thinking larger cuts at the onset while moderating over the longer term. And so with regards to the future of the economy, it really is still riddled with so many uncertainties, which is contributing to these divergent views. And so over the past year, the markets and the Fed have really been have differing in terms of ideas around where rates should be, which gets us really to what my colleague Jeff is going to talk about here shortly, which is there have been a lot of mispricings in the market that had provided some opportunities here. And maybe we can get to that. Maybe I'll turn it over to Jeff. Actually, before we turn it over to Jeff, was there anything to add here with regards to that?
No, I think you did a great job. And thanks for setting it up kind of to think about the action items that we can do based upon rate movements, market forecasts, our forecasts, the Fed's forecasts, and kind of boiling it all together. So as we go on to the next slide, it's a pretty dense amount of information. So I'm going to walk through both of them. And they'll be pretty similar, but the top left graph has 3 main components. The dark blue line is the Fed's forecast of where they see the Fed funds rate ending 2023. So starting off in early 2023, the Fed had the view that the Fed funds rate would end slightly above 5%. What this means is they were anticipating 3 additional rate hikes this year. The light blue line speaks to the markets forecast. So the markets forecast is a derived figure that comes from the yield curve and different derivative instruments. So it's actually, this is what we then invest into as investors. So the market was saying no rate hikes on net throughout 2023. As we entered into February of 2023, the market completely, had to dismiss their previous forecast and move from saying no rate hikes to 5 as continued strong employment and economic data continued to enter the market. So they completely changed course. Obviously, the actions throughout March and April of 2023 did cause some volatility. And you see that within the market's expectations of moving the Fed funds rate expectations all the way down to 375. The interesting part during that is in mid-March, the Fed raised rates for its second time in 2023. Again, talking about they wanting to get inflation back down to the 2% target. I think the most important part on this graph is point number 2. At that point in early May, the Fed noted they raised rates for the third time, 25 basis points, yet the market is now implying that they were going to cut those all the way out by the end of the year. So what do we do about this strategically? So we saw the economy continuing to be, moving along, employment was strong, inflation was still stubborn, if the consumer seemed healthy, is when we go to reinvest, do we want to reinvest into the market that is pricing in 3 cuts by the end of the year? We may end up reinvesting to be maybe slightly shorter duration, trying to sidestep some of those market expectations and not buy into them, really buying into longer duration, where then you are justifying those market perceived forecasts. We were probably a little bit more in alignment with the Fed, where they raised rates and said, we're going to leave rates higher for longer. Now, as we moved into bullet point number 3, which is the more recent data, the Fed and the market are basically in alignment. The Fed says maybe we'll raise rates one more time this year, maybe we won't. The market is about the same thing, about 40% expectations for a rate hike this year. As of today, there's been a whole chorus of Fed members speaking. Chair Powell speaks tomorrow. They've all tipped the hat that they don't plan on raising rates at their November meeting. So it really just leaves the idea of December. But it's a pretty split vote, I would say, within that group. Now, if we look to the graph on the right, this is where does the market think the Fed funds rate will end at the end of 2024. So as of earlier this month, the market was right around 475. So this would imply about 2 cuts from our current level of Fed funds rate. So they are anticipating cuts. Now, the Fed is not quite at that same level. They're a little bit higher. But I think when we look at the trend, just in July of 2023, right after the Fed raised rates and continued to say we anticipate leaving rates higher for longer, the market was anticipating the Fed funds rate ending the year of 2024 at 4%. So that would mean 5 rate cuts from that Fed funds rate that they just increased. After that, at the end of July, they're going to cut it 5 times. We didn't feel that the Fed would be that aggressive in 2024. The data was definitely not showing that. So buying into duration, you would then be buying into the likelihood of those cuts. You'd be justifying that. So we tend to stay a little bit more shorter duration. Now, as the market has definitely moved back towards closer to the Fed's forecast, pricing in a reasonable amount of cuts, it may make sense to have a little bit more duration. Now, could it go higher? It very well could. As of today, the market is a little bit higher at about 4.85%. The current Fed funds rate, as noted, is about 5.33. So the market's anticipating about 50 basis points of rate cuts from the current level, of which I think is very hard to discount. So as we look at the next slide, we kind of boil all of this together into, we don't know where rates are going to go exactly, but we kind of have a feel thinking about probabilities and, could rates go higher from here? Absolutely. Could they go lower? We definitely think there's a strong chance that there are impulses in the market that could cause rates to move lower. So starting back in earlier this year, when rates were coming into the year where the market was saying no rate hikes and the Fed was saying 3, the 2-year Treasury was, in the low 4%. We definitely felt the market was discounting the strength in the market or in the economy, and discounting the Fed's willingness to raise rates and to keep them higher. Sure, there's always a chance rates could continue to move lower due to exogenous events, due to other things that could happen in the economy at that time, but we definitely felt that the risk reward, that there was a risk of them moving higher. Same was the situation in that early May time period that I spoke about previously. The Fed just raised rates and they confirmed they wanted to leave rates higher again for longer, yet the market was giving zero credit to the Fed and to the economy. Obviously, that was quickly reversed by the market as we see the 2-year make a 100 basis point move from May to roughly the end of June. And here we are today, sitting in mid-October, 2-year Treasury is about 5.2%. Where do we think it can go from today? Well, we think we're close to the top. Could it move a little bit higher? Absolutely. And what could cause that? If inflation was to come back up a little bit higher, if the job market was to tighten even further, or some other bond buyer strike where people completely rebuff buying U.S. Treasuries. But we definitely feel that there is the ability for Treasury yields to move lower for a litany of reasons, right? There's always the tail risk event. We saw the 2-year Treasury move down by 100 basis points very quickly in March. So it does have the ability to go down. So what we're thinking about in portfolio positioning is, if there's the risk tolerance, the runway, and the ability, is to take on a little bit of duration, invest in these historically high yields, and lock in and preserve some of these, very nice income levels within a portfolio. Again, it's very hard to top tick and pick the peak, but it might be smart to start to add in some of that income insurance within a portfolio. Looking at the next slide, we have some of those, we've been brainstorming some of those ideas. What are some of the reasons that could move yields lower? And we think that there's a tilt to that. Moderating inflation data. So we've seen inflation on the core PCE, core CPI. It has steadily been moving lower over the past, let's just call it 6 months or so. That can continue. We're seeing those inflation things like used car prices and such, reducing as we go. And also year over year, base effects are starting to, come into play that will lead to lower inflation figures being reported. We're seeing some consumer stresses in the market due to higher rates, right? Credit card bills are becoming, a bit more difficult to pay as interest rates continue to rise. Student loan repayments have just recently started. And all the COVID extra stimulus money is starting to wane. Several of the bank earnings were happening over the past week or so, and several of them have noted that they have started to see some slowing in the consumer, not at a scary pace, but they are starting to notice some of the consumer slowing. The lag policy of actions, I think Jose noted this quite nicely previously, is the Fed's moved a lot really quickly, and some of these policy actions could still be taking effect within the economy, of which could also put the brakes on some economic expansion, slowing global growth. And then the last two, as we've seen over the past couple of weeks, geopolitical risks and unforeseen tail risks. There's always those we didn't see that coming type of situations. And then, the geopolitical risk, which is a very hard one to determine which way things could go. So we think it's a smart time to have a little bit of duration, some income insurance, and try to preserve some of these above 5% yields within portfolios. Now, what could move these things the other way? We're not trying to say we're always right, but we definitely think that things are tilted in the favor of rates staying roughly in alignment or moving lower. Strong labor market. We've seen the last report. Labor's doing well. A resurgence in inflation due to some reason. Hopefully, it's not another pandemic or something else. Corporate earnings continue to be fairly strong. Supply and demand dynamics in the treasury market. We have seen this over the past couple of months where the long end of the treasury yield curve, 10-year, 20-year, 30-year, has moved up over 100 basis points over the past 3 months. And that's really due to supply and demand dynamics within the treasury market. And then the Fed's balance sheet, they're continuing to allow securities to run off, of which is adding more supply to the market. So that's we just think the balance of power is potentially for the yields to move a little bit lower over the coming months. Jose?
Yep. No, thanks, Jeff. And you described it really well, because I think the one thing to add here is, I think to that point, I mean, if you tip the scales, it really is towards the left side of this slide here with regards to some of the catalysts that could push yields lower, and you describe that really well. And I think if anything too, recent Fed rhetoric has really reinforced that point. And if you can move to the next slide, just wanted to show everyone really what some of the Fed members are saying. I mean, you got Bostic saying no need to raise rates. You got Michael Barr saying that, additional rate increases may not be needed. I mean, you have Mary Daly, the San Francisco Fed president, saying that that the Fed has increased rates so quickly that that we need to see the data essentially translate or move in that direction. So again, that lag effects that we were talking about. And then, I mean, we even had Waller come out today, talk about that maybe they can take a wait and see approach before deciding on rates, and that if the economy softens, that the Fed has some room to wait on hikes. And if anything, I think Jeff had alluded to this, the curve has steepened pretty dramatically over the last 3 months. I mean, with that recent move higher in rates, as Jeff mentioned earlier, the 2-year note as of today breached 5.2%. The 10-year note is almost at 5%. So the curve's pretty much doing the Fed's job for them. So they may not need to raise rates at least this year. I mean, I think we have a probability of, I believe, 40% of a 25 basis point rate hike between November and December. And as Jeff had mentioned, probably likelihood that, if anything, today's move only reinforces a possible pause or meeting, right? So with all that said, right, I don't know, Jeff, if there's anything to add to that.
No, I think you're right. I think that there's definitely a consensus among the members, or a majority of them they're willing to wait and see for a number of reasons, that they've already done a lot. They want to see those effects, but also the movement in the yield curve more recently is definitely causing some impacts, and they kind of want to see how that may digest through the market as well. And that could just be the effect that could alone be worth a rate hike or two.
Right. So even if the Fed were to even hike and say pause for a prolonged time and maintain this narrative of higher for longer, question is now is how do we still position? Does it still make sense to even take in on some duration? And we still think it does make sense. And if you turn to the next slide, I think the main takeaway here is that we mentioned it in the previous slides, where historically the speed of Fed rate cuts are very dramatic and very, very hard to time. And we want to be able to be put in a position where we don't want to be caught short, right? And if you look at each of these 4 strategies, and we just simply put together simple treasury strategies between cash or money market funds, let's just say, and then you have a short, intermediate, and longer strategy relative to our corporate cash investors. And you can see that there's a lot of uncertainty between the future path of inflation, where labor markets are headed, what the economy is, and let alone what the geopolitical risk and what that impact's going to look like on rates. All of that's going to remain uncertain, at least for now. And you can see here, and what we did was we tracked over the past 3 easing cycles in 2000, 2007, and 2019. You can see here each of the strategies, each of the strategies where you are taking on duration have outperformed money market funds or cash, so to speak. So really the takeaway here is duration can be your friend. Interest rate risk is not necessarily a bad risk, because right now, as Jeff mentioned earlier, the risks are now, looks like it's tilting towards our portfolio's favor, who have been short over the last couple of years, and that now's the time to maybe leg in on some of that duration to mitigate reinvestment risk, lock in that income certainty, right? And even from a budgeting perspective, right? This will help with regards to forecasting income and reducing the uncertainty around that cash budgeting plan. Um, so with that said, Nanci wanted to make sure too that we had enough time here to address some questions.
Yeah, and we've had several submitted. Thank you. First question was from Sandrine McDonald. Jeff and Jose, could we expect to see interest rates go down by the end of Q1 2024, as some predict?
Well, I would say the market has largely priced in a mid-2024 first cut. The Fed doesn't go off on a monthly or quarterly cutting forecast. They do it on an annual basis. So I think that would be a bit early. And I would say it's pretty early given, the data that we've seen economically. A great jobs report, inflation still high. I don't think the Fed could change their tone from we may potentially need to do more hikes to then cutting without some sort of tail risk, without something that just pops up or then they're forced to do it, of which it's very hard for us to forecast those types of things. So I would say it's unlikely for a Fed funds cut in the first quarter of 24.
I would
Great,
agree as
thank
well.
you. The next one, the consumer has been resilient. Yesterday, we saw a strong retail sales report. What are the risks that front-end rates continue to climb higher?
There is a risk there, I think. But I think the relative risks are going to be minimal relative to what we think could be as we get into, because again, there's been a lot of tightening that has been, and we have yet to see the full effects of that tightening. And we are starting to see at least some pressure into that. I mean, again, inflation has decelerated, right? And growth, yes, has been trending well above, but again, we feel that these could be just minor blips in the data that will eventually lead to a longer term view of terms of, because we've seen some consumer stresses, or like, for example, credit card rates have increased that could put pressure in consumer spending that have yet to be felt. So we think that, yes, in the near term, front end rate, there's a risk that rates can come in higher, but eventually we think it'll peak. And can't reiterate enough, again, how quickly rates could move down in the event that we do pivot in the other direction.
Thank you. Our time is just about up, so I'm going to limit to one last question here. Why should companies start thinking about adding duration now to their investment portfolios when money fund yields are above 5% and inflation is still above 2%?
I think that's a great question. I mean, obviously, could the Fed raise rates 25 basis points more and the money fund rate go to 5.5%? Definitely could happen. But we think that chance, as seen in the market, is about 40%. But the likelihood that money fund rate could drop significantly and quickly is a lot, right? We think that there is that chance when we don't know when that could happen. So we think adding in duration, where the two-year treasury is at roughly the same yield as a money fund right now. It's not a huge cost to buy a little bit of duration. We were more inverted previously, where that cost was more. We do think that having that income certainty over a slightly longer horizon could be a great benefit for a lot of our clients who have enjoyed booking income for the income levels that we've experienced over the past 12 to 18 months.
That's a good point, Jeff. Oh, sorry, go ahead, Jose.
Yeah, and I can't reiterate enough too that, as I mentioned earlier, the risks are again tilted in the direction of the possibility of rates moving lower, right? And so I think it does make sense to at least leg in your way duration, even if you are uncertain, to leg in on some of that duration, not put all your eggs in one basket. That way, at least you're hedging yourself a little bit.
That's a great point. And given that we do know that money fund yields in the Fed funds target have about a 1-to-1 correlation, that's a good point. We can hold on to our investment fixed income rates for longer than a money fund can hold on to their yields. So that's the end of our webinar. Thank you for joining us today. If you have comments, feedback, or other webinar topics that may be of interest, please let us know. Our contact info is here, so please feel free to get in touch with us. We're always happy to be a resource for you. Thank you, everyone, and have a great day.